Hello, everyone, and thank you for joining the OECD ICGN webinar for the launch of the OECD's Institutional Investors Engagement and Stewardship report. We are delighted to have an amazing panel to discuss this topic with us, with Maureen Beresford, Director for Corporate Governance and Stewardship at the FRC, the Financial Reporting Council, Elisa Sensik, who is Head of Policy Engagement at Norges Bank Investment Management, Fabio Coelho, CEO of the Association of Capital Markets Investors in Brazil, and Jen Hui Tan, who is Chief Sustainability Officer at Fidelity International. But before we start our discussion, I would like to hand the floor to Stefano Cappiello, who is Chair of the OECD Working Party on Sustainable Finance and Director General for Regulation and Supervision of the Financial System at the Ministry of Economy and Finance in Italy. Thank you.
Thank you, Severin. Thank you for the introduction and hello to everyone. Thank you for participating to this joint OECD ICGN webinar to launch, as Severin was saying, the OECD Institutional Investor Engagement and Stewardship report. This report is first of all about corporate governance, how institutional investors use their rights and responsibility vis-à-vis boards and management in listed companies. However, it is not only about that, it goes beyond that, and I hope through this brief introduction to show how it goes through these topics and beyond them. It is, I think, a report that is very important, particularly at this historical juncture. Over the past decade, ownership has become more concentrated, as we will see in a few minutes when I talk you through the report. A relatively small number of large asset owners and asset managers now hold significant stakes across many markets and sectors. And at the same time, public expectations on how institutional investors manage their assets have grown sharply. And these not only to deliver financial returns, but also to take into account climate and certain social issues seriously. As a result, many institutional investors feel somehow pulled in different directions. I would say in two main directions. On the one side, the goal to maximize financial value in line with benchmarks and performance goals. I'm hesitating because when we speak about performance goals, then we have to see whether it's short-term performance or long-term performance. And this is about the second, the second pool I was referring. On the other hand, they feel pulled on the goal to help the transition, to support an orderly move towards a more sustainable economy. Our collective goal is exactly to help building a framework that makes these two dimensions compatible, and rather than treating them as two opposites. This report speaks to this double question, using new evidence on who owns listed companies, how engagement works in practice, and how laws, codes, and mandates can support credible stewardship on environmental, social, and governance issues. Let me launch the presentation, the slides that we have prepared for this purpose. And I will launch it. Okay, I guess you can see it. Okay. Start from the beginning. Okay. So for this purpose, we have structured the presentation in four parts. I will start with a brief overview of the institutional investor landscape. Then we'll move on to the practical aspects of institutional engagement and stewardship. We will then dive into the regulatory and stewardship code framework. and including the rising role of stewardship codes. And then I will close with some policy considerations in line with what has been spoken about. So let me start from a simple question. Who actually owns listed companies today? I think this slide clearly shows that in most markets we look at, institutional investors now hold a large and in many cases growing share of listed equity. Asset managers hold around 2/3 of listed equity in the US, as you can see, and close to 60% in the United Kingdom. And they also hold substantial shares in other advanced and emerging markets. In addition, asset owners represent a significant share of listed equity in several jurisdictions. So institutional investors are no longer marginal players. They are central owners in public equity markets. I don't know whether, yes, this one is showing their role. Now, what you are seeing, I think, is also the second major trend. The second major trend that we see is the rise of foreign ownership. Non-domestic institutional investors now hold a larger share of equity than domestic ones in about 3/4 of OECD, G20, and Financial Stability Board economies. You can see these on the slide. In many jurisdictions, the bars for foreign investors are higher than those for domestic ones. There are, of course, exceptions where domestic institutional investors still dominate, but overall, the picture is clear. Ownership of listed companies is increasingly cross-border, and I think this makes our role as global policymakers, as a global facilitator of global dialogue, even more important. A third message, I hope you can see slide 3, right? Importance of institutional investors is about concentration. Institutional investor ownership has become more concentrated in a relatively small number of very large managers. Over the past
I'm sorry, there seems to be an issue with the sound. At least I couldn't hear you, Stefano. Personally, the last thing I heard was that there was a concentration in a small number of investors.
Yes. Now can you hear me?
Yes.
Okay. And the slide that you are seeing is on the importance of institutional investors, right? And it's about concentration. So I was saying the institutional investor ownership has become more concentrated in a small number of very large managers. Over the past decade, the assets under management of the top 20 firms have grown strongly, and their share of total assets across financial institutions has increased. This means that a handful of institutions are now recurring influential shareholders, many listed companies, at the same time. They are in the room where boards are appointed, strategies approved, and major risk decisions are taken. Now we move on how stewardship is changing in practice. So we are moving from who owns to how these owners exercise stewardship in practice. The stewardship approaches shown on slide 7 that I hope you are seeing, I guess you are seeing, yeah, have coexisted for some time. But what has changed is their relative weight over time. Traditionally, stewardship meant one-to-one engagement with a single issuer on classic governance topics, board composition, board pay, specific transactions. Today, many large investors also run portfolio-wide thematic engagements, for example, on transition plans, on nature-related risks, on physical-related risks, on labor conditions in supply chains. The evidence suggests that over the last decade, many large institutions have broadened their use of these tools. They have moved from mainly bilateral company-specific engagement towards more systematic and often collaborative thematic engagement, including on material climate and social risks. All in all, the governance toolbox, dialogue, voting, escalation, is more or less the same, but is applied consistently across many holdings rather than one company at the time. So we move to the next slide on the state of investment funds. This slide shows you the growth of investment funds and their increasing role, especially since the global financial crisis. Today, investment funds manage around 65 trillion US dollars in assets, and this is a sharp increase from the mid 2010s. Within this number, index investment strategies have grown particularly fast and now account for a very large share of fund assets. Index strategies concentrate most of their investment in equity, with a smaller but still significant share in fixed income. Non-index funds still manage a larger overall volume, but they allocate assets differently between equity and fixed income. The key point I think that we need to draw is there is a growing share of capital that is always invested through index strategies. For these holdings, engagement and voting are the main levers for investors to influence how companies are governed and how they manage material risks, including sustainability risks. So exit is no more a possible strategy. It's voice and engagement, the way to have an impact on the investee companies. So let's turn to what forms of engagement. Now, this slide shows how engagement appears in the real world, from quiet one-to-one dialogue to collaborative campaigns, and at the top of the escalation ladder, shareholder proposals at annual meetings. The figure that are shown here illustrates that management proposals as regards shareholder proposals are more frequent and are almost always approved, while shareholder proposals are rarer and more likely to fail or not to be voted on. This is one reason why using annual meeting outcomes alone gives only a partial picture of what stewardship is. Much of the work happens through private dialogue and earlier stages of escalation. We shouldn't focus only on the outcome of shareholder-initiated proposal when we discuss about the success of engagement. And so far we have spoken about how institutional investors engage with the investee companies, but the other side of the coin that is equally important is regards fiduciary duty and mandates. So I would ask to focus on these parts. And so when we speak about fiduciary duties, we are asking ourselves what are the rules and expectations that shape the stewardship in law and in codes and in fiduciary mandates. So what governs this kind of fiduciary relationship? As we see in this slide, in most of the 52 jurisdictions covered, stewardship sits in a mixed framework that is made of hard law on how investor duties and conflicts of interest should be managed, combined with softer tools, codes, guidance, self-regulation that are focused more on monitoring, voting, and transparency. Many frameworks now explicitly expect investors to monitor companies. They say it clearly, to manage voting even when it is outsourced, and to engage on sustainability when sustainability is financially material. And events of the past years clearly show us that it is material in a number of cases, and it is a management tool to manage properly and measure and manage properly risks such as physical risks. So all in all, I think that the message we can convey from the previous slide, slide 12, is that stewardship is no longer left entirely to discretion. It is framed within a number of sources of law self-regulatory tools. And most markets now expect some form of structured stewardship to be carried out according to these sources. So now we are looking exactly on stewardship codes, the soft law backbone of this framework. At least, as we see in this slide, 19 jurisdictions now have a stewardship code, usually on a comply or explain basis, setting principles for how investors should monitor, engage, and vote. Over time, many of these codes have been updated to include sustainability within stewardship expectation. In short, stewardship codes have moved from niche experiments to a central reference point for how institutional investors are expected to behave as owners, including with respect to sustainability matters. So the next slide, slide 14, goes to the core question. What can and what cannot investors legitimately do under fiduciary duty? So we are looking at the other side, not only how investors engage with their investee companies, but also how they relate to their principal investors. Fiduciary duty, let me say, is straightforward. Investors must act in the client's best financial interest. Now, does this mean that they cannot pursue sustainability goals? I think that there is not a clear answer. I think the answer should be looked in the mandate, in the specific mandates that govern the relationship between clients and institutional investors and how they address this point. So here comes the central point, and mandates, the role they play with respect to this point. When mandates are vague, for example, they don't say whether, on, and what circumstances to engage, the discretion shifts to the institutional investors. In that space, fiduciary duty really matters. Investors must be able to explain how their stewardship decisions serve clients' interests. Clear mandates between asset owners and asset managers are critical to govern this relationship. At minimum, they should clearly spell out whether and how the manager is expected to vote, what sustainability-related engagement is in the scope, over which time horizon performance and risks should be assessed. The more discretion investors have, the more important also transparency becomes. Courts and regulators rarely second-guess individual decisions, unless there is a clear neglect or conflict of interest. In practice, discipline comes from how clearly investors report their stewardship objectives, actions, and results. All in all, I think the main takeaway from this slide is the fiduciary duties and mandates do not block stewardship on sustainability. They rather help it if they are framed in a clear way on objectives, tools, and how any sustainability-related action supports long-term financial interests. So this is, I think, a clear message that we will get back also at the end on policy conclusion. So to conclude on the state of play and next steps for stewardships. With these last three slides, I would like to step back to the beginning and to ask three simple questions. Where are we now? What what still does not work, and what should policymakers and investors do next. So on where we are, as we said at the beginning, it's clear that institutional investors now hold large stakes in listed companies, have real influence. They really can make a difference over how these companies are governed and where risks are material, how sustainability issues are effectively managed. Second takeaway is that engagement versus exit can really make the difference. For large long-term shareholders, engagement is more and more effective, and as we saw, divestment is not an option in certain cases, and it's definitely more effective than divestment. Engagement is more effective than divestment in changing strategy and risk management in general, and in particular with regard to sustainability issues. The third takeaway is that investors are already using stewardship to address global challenges such as climate, especially where financial materiality is widely recognized. The picture is more mixed and contested when it comes to social issues. Finally, policymakers and market initiatives have reacted to these trends by strengthening disclosure on voting and disclosure on engagement. And this, I think, has an impact on how stewardship codes become effective and become a common reference point. So let me conclude referring to the open challenges and policy considerations. The first challenge ahead of us that we are trying to address is alignment, aligning expectations and information needs between investee companies on the one hand and institutional investors across borders. As we saw, we are in a world where foreign institutional investors now hold most of the equity in almost 80% of OECD, G20, and financial stability board economies. This is a global issue and has to be addressed with common rules, common frameworks. The second challenge is about disclosure by the largest investors. We need to find the right level of transparency so that largest investors can show that they are both meeting fiduciary duties and responding to clients' sustainability concerns. And for this purpose, as we saw, clarity in mandates is really crucial. So let me draw three policy considerations that I hope will help to feed also the discussion ahead of us. The first one is that continued cooperation on good practices for both voluntary and regulatory stewardship frameworks is crucial, so that effective engagement is supported rather than discouraged. The second is that we need increasing convergence of frameworks for sustainability-related engagement, so to help asset owners and asset managers to align, to clarify their mandates, and to improve the integration of capital markets. The third one is that clear and credible frameworks are key to give investors legitimacy to act on financially material, environmental, and social issues, and to reduce the perception that large institutions are setting de facto social or environmental policy on their own without a clear mandate. So let me close here, recalling that we are, as I said, we are discussing this. This is a particularly important historical juncture, but on the other hand, the topics that we are discussing are not completely new. Throughout the whole 20th century, we have witnessed the discussion between shareholderism and stakeholderism. We had Walter Rathnau recalling us that a company exists to keep the boats running on the Rhine, not only to maximize shareholder value, while we had Milton Friedman telling us that the responsibility of the board is simply to maximize shareholder value. And so it is not so new as a topic. Stewardship is the new element because it sits right in the tension between these two approaches. And I really think that stewardship can be a clear fundamental bridge between these two approaches. For this purpose, I hope that reading the report, you will see that it shows that when crafted in clear mandates, robust governance and transparent reporting, stewardship can really make the difference in delivering long-term value creation and in managing key environmental and social risks in line with long-term value creation. So thank you for listening to this presentation, and thank you, Severin. I hand it on back to you. Thank you.
Thank you so much, Stefano, for this very interesting report, which gives us some food for thought and some surprising aspects and others that I think confirm our intuition, probably. Let's start a discussion with our speakers, with our panel. I'd like to start with Elisa from Norges Bank. Elisa, how does NBIM stewardship team ensure that the internal portfolio managers, but also your external managers, make investment and stewardship decisions that align with your objectives and the mandates that you've given them?
Thank you, Severin, and thanks to the OECD and ICGN for the invitation to be here. I'm really pleased to be here and speaking on this webinar today. So I will start with the internal side, given that we manage less than 5% of our equity holdings through external managers, but I will get to that as well, because that's obviously important, and that's where alignment can be slightly more complicated. So in terms of our overall framework, we have a very integrated responsible investment framework. So we have very clear mandate. Back to what Stefano was saying in terms of clarity on mandate, I can confirm that's absolutely key. And also governance documents, which include our executive board principles for responsible investment management. And these governance documents clarify that ESG considerations are an integral part of the investment process. So what this means is that our portfolio managers are required to consider material sustainability risks in their investment decisions and strategies. And there's also a formal documentation process around that. This is, of course, within the aim to achieve the highest possible long-term return, which is the overarching goal of our mandate. So the integration lens is really through financial materiality. So how we do this in practice? We have a very structured collaboration between our stewardship teams and portfolio managers. So probably similar to many institutions, we have a dedicated stewardship department, which we call active ownership. Our stewardship teams systematically coordinate with the internal portfolio managers, again, through many different processes. Not all of the companies that we own are covered by an active investment mandate because many of our holdings are managed passively. However, for companies that are actively covered by PMs, which is still a significant amount, particularly in absolute terms, the stewardship team shares research, but importantly discusses all the voting recommendations with the relevant portfolio manager before they enter a vote instruction. So particularly when we talk about governance-related votes, such as capital allocation, CEO pay, these are often subject to specific discussions with the PM, who have typically a smaller coverage compared to the stewardship teams and usually know the management team and the board extremely well. So these conversations are really mutually beneficial because they ensure that the investment insights from their side inform the ownership decision and the voting and vice versa. So to give you just some statistics, last year in 2024, the portfolio managers participated in voting decision at around 600 companies. Now this might seem small because we own around 8,000 companies. However, they are among our largest investments. So actually these companies make up about 60% of the market value of our equity portfolio. And of course, this collaboration extends beyond voting. So whilst we might have specific meetings on sustainability topics, such as climate change or human capital, which are held by the stewardship teams, many meetings, particularly with the CEO, the CFO, or the board, are held jointly between the stewardship teams and the relevant portfolio manager. So again, to give you the relevant figure, last year portfolio managers attended around 2,600 meetings with companies, and in 60% of these meetings, they discussed governance and sustainability topics. So the approach is quite well integrated. We also have a range of tools, of course, data-driven tools, as again, everyone these days, and an ESG analytics team, which provides analysis to inform both the ownership side and decisions, but also investment. So these includes maintaining some non-financial databases, thematic analysis on material sustainability issues, and tools that integrate both financial and non-financial data. So to give you maybe some examples of these tools, which we are all made available on our internal investment platform. We have a climate performance feature that includes information on the carbon emissions performance of companies relative to their peers, ambition level, targets, so on and so forth. Still on climate, we're using AI to analyze systematically the earnings calls transcripts and identify how companies discuss climate-related topics. And also, last but not least, last year we introduced something we called expectation scores, which is a systematic evaluation of companies' disclosures and performance against our responsible investment expectations. These scores are built using data from multiple providers. We use AI as well, we use machine learning techniques. And the scores really look at how companies perform on key expectations that we have, such as climate risk management, anti-corruption measures, biodiversity, human rights policies, so on and so forth. And again, these scores are available to the portfolio managers on our internal investment platform. So this is just a few things that we're doing on the internal portfolio manager side. On the external manager oversight, we have a very rigorous, again, as with everybody, a very rigorous selection and monitoring process. So that includes evaluating whether the managers comply with our standards of ethics and with our values, but also looking at, ensuring that obviously the portfolios or the segregated mandates in this case are managed in accordance with our standards. And on sustainability specifically, all the external managers are subject to regular, very frequent monitoring of how they manage ESG risks and obviously also operational performance, financial performance. They are all familiar with our expectation documents, which we've published over the years, over 15 years now. And we also evaluate their approach through sustainability through a dedicated questionnaire and evaluation process. So we have an internal team which is really dedicated to selecting and monitoring all the external managers, and that's quite a lot of considerable resources devoting to that. So this is how we try and minimize any potential agency issues or potential misalignment. The last thing I wanted to mention is, which is also great when it comes to this collaboration, is that we often receive voting input from the external managers, which again we discuss with the stewardship teams and with the internal PMs. So it's a lot of coordination, but overall it's quite a well-oiled machine where we're quite hands-on, I would say.
Thank you, Elisa. This is really interesting and really helpful, and also good to remember that only 5% of the fund is managed externally, which I think few people know, given the size of the fund. Is quite impressive. Fabio, I have a question for you. So we've seen in the report that institutional investors now hold over half of listed equity in the US and the UK, and at least 30% in many advanced markets, and over 20% in major emerging markets. Given that institutional investors' influence over governance and market behavior, what role do you see for industry bodies like yourself, like AMEC? What role do you play in setting expectations for the responsible use of this influence?
Thank you, Severine. Thank you, OECD and ICGN for organizing this webinar. And it's interesting to talk a little bit about industry bodies like AMEC, because it's important to highlight, in my perspective, that not all jurisdictions, Stefano mentioned 19 jurisdictions with stewardship codes, not all of them have the support or the same support of the regulators to develop this, this path to recognize that stewardship goes into the direction of a public good that demands kind of a public policy so we can have the benefit of the society, of the countries. So with that said, we should recognize as well that the role of bodies like OECD and ICGN in terms of coordinating data, best practices, even like a stage where some professionals can discuss topics related to stewardship is something that helps a lot other countries like emerging markets to also have contact with the topic, because if we consider the nature of the development of different markets, considering that we have like a global audience here for the webinar today, it's important to highlight also that the size of the markets and cultural aspects are also relevant when we talk about the stewardship practice. So when you ask me about, Fabio, the role of like investors associations like AMAC to play in the stewardship practice. So if you take a look about what usually happens between investors associations around the world, they work together with the regulators to kind of articulate a minimum standards without waiting for a formal regulation, acting like kind of a soft law or best practice or something like that. So, for example, if we take into account what AMAC plays here for Brazil in terms of the role, we could organize some engagements with some specific companies. We could eventually have provide some support materials. Other associations around the world, they act like a proxy advisors as well. This is not the case for us here. But most important, we have some specific education material that we can support for our signatories. But Stefano mentioned, as I said, like 19 jurisdictions with stewardship codes. And I highlighted here the fact that not all of them have the support of the regulator. For example, if we take into account the most relevant of the stewardship codes, being the UK, like a reference for almost all the other 18, we have like almost 300 signatories in the UK for the code. Here in Brazil, to give the perspective of difference in size, we have 30 signatories. So I can clearly see that we need a local support to bring these ideas, international ideas, to play here in the country. Because we have a very important difference between investors that come with this international perspective, as Elisa mentioned, to have a more dedicated stewardship departments between some international investors, and we have the local reality. Most of the native Brazilian investors, they do not have dedicated staff to do this. And usually they only play stewardship being for voting in the AGM. And as Stefan also highlighted, this is a small part of the stewardship practice. And usually what happens is that investors associations like AMAC, we bring this idea from what's happening around the world and try to stimulate local investors to be in contact with international ones so they can engage in a more specific basis with companies. I believe this is not a reality only for Brazil. This is characteristics of emerging markets. But just to conclude, when we have contacts within ICGN, for example, and you know this well, with other jurisdictions that have stewardship codes, they have almost the same reality as Brazil. A small number of signatories, they do not have a support for the local regulators, and this makes our work more difficult to be played. And I will highlight again that this specific report being disclosed by OECD is the state of the art in terms of what we have in terms of compilation of information. And I would like to see Caio and other colleagues from OECD more of this in the coming years, because we at emerging markets, we would welcome a lot this initiative, and we believe that is going to play an important role to kind of make our security regulator to pay more attention to the relevance of stewardship and try to create a regulatory nudge to support the development of our work.
Thank you very much, Fabio. Oh, I see Stefano, would you like to react? No, maybe it was an IT.
No, it was an IT issue.
Yep. Look, I think it's an interesting reminder of the different local culture, different resources that investors can dedicate to that, but also the support or not of the regulator, and that's an important point. Which brings me to my next question for Maureen. You mentioned, Fabio, that the UK code is, of course, a reference globally, a reference standard globally. So, Maureen, I'd be very interested to hear your thoughts on the role that regulatory authorities, standard setters, policymakers, the role they can play in best supporting improvements in institutional investor stewardship and promoting best practices.
Yeah, thank you, Severine, and good afternoon, everybody, and thank you for inviting me to be part of this panel. And I'd like to congratulate the OECD on its report. It's a great piece of work. And I've now got to thank Fabio for his very kind words about the UK Stewardship Code, so thank you for that. I think it's really important to think, when you think about the UK and our Stewardship Code, to remember that it's part of a framework. We're responsible for the Corporate Governance Code, we're responsible for the Stewardship Code, and we work with other regulators within the UK to think about the objectives, what we're trying to achieve, where one does one thing and another does another thing. So we don't work in isolation. And we do try to say that the Corporate Governance Code and the Stewardship Code are two sides of the same coin working together. And we want to see a thread from the beneficial owners right through to the companies that they own, and to make that framework work together effectively. But I think it's important that regulators don't overstep the mark. We're a regulator that is looking at transparency. It's looking at good examples. It's looking at promoting good practice. There are other regulators and the government that set the actual regulations, the laws. So I think it's really important to understand that framework in any country to determine how all these things work as a group of measures to promote the best outcomes for all. And we've been very careful in the UK to not tell investors what to do. I think it's not our role to say what you must do, what your objectives should be. It's a principle-based approach. We encourage signatories to report on their policies and their practices, their governance, for example, and their conflicts of interest, but we don't tell them what that has to be, what the standard is. We want that transparency. And we want transparency that encourages others to strive for similar levels of attainment. And I think the UK Stewardship Code has been successful in focusing institutional investors on the importance of stewardship, not only their objectives and their policies, but making sure that the policies that they have are actually doing what they're set out to be. I think it's really easy to have a policy and a set of potential practices that are never dusted off. They're put in a drawer and forgotten about. And I think by encouraging transparency, we have made stewards and investors think about what they're trying to achieve and how they're going to achieve their objectives by using those policies on a day-to-day basis and setting those out really clearly in their reports. And I think the OECD report, it talks about the importance of an effective regulatory framework. And I think this is very much in line with the UK approach, where the FRC encourages that transparency through disclosure, and the FCA, for example, is more involved with the fiduciary duties. And I think Stefano said it's a mix of soft law and hard law working together. And I think, for example, if I give you an example, we ask our signatories to set out their conflicts of interest. We ask them to describe what their policy is and set out what it does and how conflicts are managed and how they might be managed in the future. And that transparency gives that confidence to people who are reading those reports. And I think that confidence is extremely important in terms of beneficiaries, stakeholders that are thinking about the market. I think we also think about the activities and outcomes of stewardship. I think that's really important. For example, we ask for impacts and outcomes related to systemic risk, engagement, how stewards and investors maintain or enhance the value of their assets. And this is actually demonstrating what they're doing every day for their beneficiaries. And that is so important because they will all be different. And I think that's really important. The objectives of one investor will be very different to another one. And we need to acknowledge that in our approach as a regulator, that it is not a one-size-fits-all approach. What we do, we don't tell people what to do, we do set out guidance, and I think that's really important as well. But our guidance is not additive. We don't want people to look at our guidance and think, yes, we have to do more and more. We want a proportionate approach to stewardship in the UK, where those that want to be signatories can look at our code and apply it the best way that they can to their priorities and objectives, business model, etc. So I think, our code is framed in such a way that it allows signatories to report on their varying approaches to stewardship, a great deal of emphasis on case studies and examples that brings that stewardship to life. And then that we want to say that reports are successful and are available to everybody on a website, so anybody can look at these reports to see what is happening in the UK. And we think our publications demonstrate a high standard of reporting. Each year we put out a review of our reporting to demonstrate good practice. And I think that's a really useful tool for others to look and try and to attain higher standards or to learn from others. So we don't work in a vacuum. We engage with our community. We engage with our signatories and stakeholders. So we'll have webinars, we'll have podcasts, etc. And all these activities that we do as a regulator is to bring forward ideas for improvement, to improve stewardship as we go forward over the coming years. And I'd just like to sum up by saying it is important that we're not prescriptive and we do not tell signatories how to practice stewardship, but encourage them to report in a way that offers transparency to their existing and potential clients over the long term.
Thank you, Maureen, for this great explanation, especially as the code has been revised recently. So it's really interesting to hear your thinking on that. You mentioned something that I thought we didn't discuss much, but just a little thing that I find interesting is systemic risk. And we talk a lot about systemic stewardship, and it's also something that is recognized in the code. Stefano, you mentioned, right, that investors have, in a way, a fiduciary duty to manage company-specific risk, but also to look at the systemic risk impacting their portfolio. And that explains also some of the changes perhaps in engagement and the stewardship tools that are used to address this systemic risk. So I know that many of our members are talking about that, how to improve systemic stewardship. But I have one last question for the first round of questions. Is for Jen-Hui. In the report, something I would perhaps have described differently, but in the report, there is sometimes a discrepancy or two elements put in opposition. financial returns, financial performance, and sustainability goals. And I'd like to hear your views on that. Do you see sometimes sustainability-related issues creating a trade-off with financial performance? How do asset managers like yourself navigate these potential tensions in a way that is aligned with your fiduciary duties?
So there's an easy way to answer that question, and there's a very, very hard way. The easy way is referenced by Stefano earlier in his comments, which is to ensure that the IMA or the product design for a pooled vehicle reflects the sustainability objective as well as the financial objective. And then you have a very clear alignment between what the asset manager is instructed to do within the context of their fiduciary duty and what the asset owner is seeking for in selecting that asset manager. I think that is the most straightforward way of doing that. The reason why this continues to be an issue is because very few IMAs actually specify that, despite what has been quite a long debate around this topic, and that needs to be addressed first. Why is it that most IMAs do not actually reflect a sustainability or stewardship component when they seek goals from asset managers? If the mandate is silent, then I think investment managers really have no choice but to exist within what I would call the win-win space. So you can only really pursue something that is both beneficial to financial performance and has a sustainability related benefit to it, but being very clear that your fiduciary duty is around the performance of the financial part of the portfolio. And for some people that may feel quite restrictive and quite constraining. I think the broader challenge, and I think the question that your question invites, Severine, is the concept of fiduciary duty sufficient to cover the range of risks that we have? So here what I'm thinking about is a market structure and a set of legal duties that have largely evolved in the context of managing idiosyncratic corporate risk. So how do you get companies to do better? And to some degree, market systematic risks, things like interest rates or GDP growth, market-wide economic factors, which you can address through diversification and hedging and so on and so forth. What the concepts are not good at, because we haven't evolved them for that current environment, is systemic risks, to your point, Severin. Risks that genuinely cover and span the health of the financial system in the aggregate, upon which returns are ultimately premised. And I think that the challenge here is that fiduciary duty and engagement is a quite insufficient, it's a necessary but insufficient tool to deal with systemic risks. And here I think it's very important that as an industry, we are very honest about the limitations of engagement. You know, I'm an engagement professional, it's what I do, but I think our case is strengthened if we are very clear about what this can and cannot do, generally to address idiosyncratic risk that is aligned with long-term financial resilience, but to ask a company to internalize a systemic risk that currently is not being priced by the market is to ask them to assume a competitive disadvantage, which is inconsistent with fiduciary duty on the one hand, and also quite unlikely to be adopted by a company because they also have duties to their shareholders to maximize the value of their companies. So I think there probably is a practical answer to this, which is centered around getting better contracts and getting better arrangements and disclosures between asset managers and asset owners, and better transparency and all the good things that Maureen and Fabio were talking about with the stewardship code. And then there is a broader discussion to be had about, look, what actually is the ability of engagement and fiduciary duty to address market-wide systemic risks, climate change, biodiversity loss, social inequality, and what is the right way to tackle those, and what is the right role of the financial system in addressing these risks?
Thank you, January. And I love your comment, because I think we could make just a webinar just to discuss this, and we would hear different views, and it's not a simple question, and I know investors have also different perspectives. So thank you so much. Elisa, building on Jens's consideration about fiduciary duties, I would be interested to discuss NBAM's special case. So as the sovereign wealth fund, you have in a way one client. So with a clearly set environmental and social priorities, perhaps. So how does NBAM pursue these sustainability goals while not overstepping on your investment mandate and your focus on maximizing long-term returns?
Thanks, Severin. And yeah, absolutely. Before I get into answering this question, I just want to say I completely agree with what Jen-Hui just said, and that we could do an entire webinar talking about the limitations of stewardship. And just to add that it's something that we're also always at pains to underline and put a lot of caveats about what we can and cannot achieve. We firmly believe in our approach, which is engage to change. And we have done actually quite a lot of systematic work recently to show the outcomes of our first climate action plan, which we published in 2022 and covered the 2022 to 2025 period. We just published a new one leading up to 2030. And we see some very encouraging outcomes and progress. But again, we need to be very, very careful about attribution and what institutional investors can actually achieve through stewardship. So just wanted to agree on that point. On your question now, you're right that it's fair to say that being an asset owner as opposed to an asset manager with many different clients with potentially diverging priorities, it is much easier for us to achieve this alignment and to achieve the clarity of the mandate or the duties, if you'd like. So I'm aware that we are in a bit of a privileged position, if not a special case, as you say, because the consideration of sustainability priorities is indeed not an add-on, but it is directly built into the management mandate for the fund. Perhaps it's useful for me to quickly explain the governance structure of the Norwegian Sovereign Wealth Fund, which allows for this alignment between what is our ultimate owner, which is the Ministry of Finance in Norway, and Norges Bank, which is the manager of the fund. So the management mandate is set by the ministry, while Norges Bank operationally manages the fund at arm's length, and that's obviously overseen by our board as well. The key components of the management mandate, however, such as allocation to different asset classes or key elements of the responsible investing frameworks, such as the ethical exclusions which we have, they are also widely debated and anchored in the Norwegian Parliament. So to really make sure that we have a broad political consensus, and that's been happening over the years since the fund was established, and that's provided a quite successful model. So as I was saying, the mandate explicitly includes responsible investment. So what it says is that the objective for the fund is the highest possible return with acceptable risk, while including explicit provisions for responsible investment management, in line, of course, with international recognized principles and standards, such as those from the OECD. And the mandate also establishes directly and clearly as a long-term goal that our portfolio companies should have activities compatible with global net zero in accordance with the Paris Agreement. So again, that's where the important systemic risk element comes in. And all this means is that sustainability is not separate from our core investment objective, but it is really integrated into it. We also have a really strong emphasis on financial materiality, as I was also explaining before in my previous answer. So we consider sustainability issues that impact long-term value creation. And we do firmly believe, and we again stated this on all of our governance document, that our long-term returns do depend on sustainable development, not only in economic terms, but also in environmental and social terms, as well as functioning and efficient markets. So really, we see managing ESG risks as essential to achieving our financial objective, not a distraction from them or something that pulls in the opposite direction. Maybe to get a little bit more concrete, I've talked already about integration and collaboration with the internal portfolio managers and with the external managers, but maybe it's useful to say a few words about how our risk work and also the risk-based divestments to illustrate this point about the financial materiality and how sustainability is embedded into the investment mandate. So as we all know, poor corporate governance, material sustainability risks, which are not managed, can become significant risks for the valuation of a company and can impact returns. So we have a strong ESG risk monitoring function, which performs regular monitoring of all of our portfolio at different points in times, daily, as well as quarterly and annually, depending on what is being looked at. And it's really trying to identify companies where the valuation may be adversely affected by its management of sustainability issues, or rather, I should say, lack thereof. And there, on the basis of this analysis, we can perform risk-based divestments. These divestments are financially driven decisions. They are not motivated by pure, ethical concerns. So this means that we have a very strong financial focus, and the activities and the divestments in this case are really embedded and aligned with our fiduciary duty, or in this case, our mandate to maximize returns. So the divested companies remain in the equity benchmark index, and they also impact our relative returns. These divestment decisions are not made public, as we also don't do for the general investment decisions of the fund. To give you an idea of this tool, though, last year we divested from around 50 companies, again, out of around 8,000 that we own. So it's a tool that we only use at the margin, so to speak. It's a quite a limited tool, including because of this risk budget and tracking error. We identify companies with significantly heightened risks on different sustainability topics. So the most kind of obvious or most common ones to perform these divestment decisions are potential violations of human and labor rights, insufficient management of corruption risks, business models that are highly exposed to environmental risk, or mismanaged or unmanaged climate risk. Altogether, since 2012, where we started making risk-based divestments, we have made 575 divestment decisions. And it's quite reassuring to see that these risk-based divestments have actually increased the cumulative return of our equity management by 0.44%. So we're actually seeing that managing sustainability risks, at least for this kind of smaller holdings, enhances rather than detracts from financial performance. So I'll stop there. I hope that was useful.
Yes, thank you, Elisa. It was useful, and at the same time, we are starting to receive questions, which is great, because once we finish our panel discussion, we will open the floor to questions from the audience. So feel free to write your questions or prepare them. And that, Elisa, your risk-based divestments are a different thing than your ethical exclusions, which is a separate.
Absolutely, and maybe it's worth explaining very quickly. We have indeed a separate approach to ethical exclusions, which is again partly a political decision, and it's values based. It's not financially driven. So we have several product based exclusions, such as certain type of weapons, coal, or cannabis, and we also have norms-based or conduct-based exclusions. And to manage these, we have a separate body called the Council of Ethics, which provides recommendations to the board on making these exclusions. And again, these are not necessarily financially motivated, so it's a separate framework and separate approach. Although I understand sometimes it's hard to for an external stakeholder to grasp the difference. So thanks for the reminder to explain.
Thanks. Thank you for clarifying. So Fabio, I have a question a little bit different, moving to a different theme, but what would be the ideal scope of disclosure by institutional investors to ensure that they can keep a constructive dialogues with their investee companies?
Thank you, Severin. The true answer should be it depends. But I'll develop on this, because our experience shows that a more principle-based approach usually works best for some reality in terms of disclosure. Investors in general, they disclose their engagement policies, eventually the escalation tools they are going to use, how they're going to manage conflict of interest, the prioritization that they will do in terms of selecting companies. But it's like basic stuff. And when we take a look about what investors they are doing in terms of disclosure. And I said in the beginning that it depends, because of course we have companies and companies and problems that should be solved depending what they're going to use. For example, when we take a look with another principle that investors would generally like to use is that granularity in terms of disclosure should correspond, of course, to materiality in terms of what is relevant for the specific company. So not every engagement should be, like we say, like a case study in terms of documentation. And of course, I believe that markets expect investors to show what is the focus that they are going to do in this company and the other company in terms of stewardship. So, as I said, depending on the problem of each one. For example, taking the reality of a lot of emerging and Latin America markets, we have a lot of SOEs. So there comes another kind of problems when we have to engage with specific companies. And so we have to deal with more related party transactions, conflicts of interest, and mixing the public nature of the company and state-owned and etc. So here in Brazil, we have a very small number of corporations. So this different reality, and investors, they usually do not have this experience of developing a lot this kind of disclosure. But regarding, for example, the voting aspect of engagement and stewardship, investors here in Brazil, they usually goes in the basic stuff, as Stefan mentioned in the beginning, like remuneration, capital allocation, related party transactions, and more specific in this time here in Brazil, discussing a lot of M&As and audit issues regarding some problems that we had. But to complement this, I should also say that investors, they like to use the escalation framework. And they evaluate on a case by case what should be public. For example, when they start to a letter, they go straight to the company. Usually they go to the investors relations department and send a letter and request for a meeting. Eventually they escalate and try to nominate a board member. And then the kind of information they are going to disclose in each of these steps is going to be different. For example, when they come to a point that they have to vote again strategic topics on an AGM, they usually start to be more activists. And we have some cases that they try to write an open ad in a specific newspaper or journal, and the kind of the type of information that is going to be disclosed is be more complex. So eventually they come to say publicly that the company needs to be shaken, and of course they will evaluate if it's going to be the case to exit the company or to go to a more strong act that they have to adopt.
So in a way, in this case, public communication becomes a tool to put pressure on the company.
Definitely.
Maureen, please feel free to react also to this question of the right level of stewardship disclosure. But otherwise, my question for you was how regulators can promote coordination of stewardship frameworks globally, as we see that there are a lot more non-domestic investors, and we've seen that in the report.
Yeah, I think the level of disclosure is complex. It's based on, whether you're domestic, you're international, etc., what your priority is, how mature you are, etc. And we've got some very large asset managers, asset owners, and very small asset managers and asset owners, and their levels of disclosure will be different all the time. There'll be some really international collaboration examples that our signatures give And then there might be some small cases that are equally relevant and useful for everybody. And I think it's really important to say, it is what's material, it is what is important to your investing objectives, and it's demonstrating that you're delivering for your beneficiaries. So the level of disclosure is all about what is important to that signatory to our code, I think. So it's not as easy as saying it should be at this level or it shouldn't be at this level. From our point of view, it's what is right for you and what actually marries up with what you're telling us in your stewardship code reporting about what you're trying to achieve as an investor in different markets. So that brings me on to different markets and how we kind of can bring policymakers potentially together. And I think we all know that stewardship is global. Investors are pretty much global now. I think we did some stats and we estimate that 40% of our signatories to the code could be characterised as global investors. That's a huge number, really. And I think I would say it's testament to a code when you can actually encourage domestic investors to report on all the things that we ask for in our code on a principles level, both in terms of what they do in the UK market, but also what they do in overseas markets. And then that is about the flexibility that principles-based approach gives you. And I think equally that overseas investors can look at our code and go, actually, we might have different cultures, we might have different laws, we might have different approaches, but this structure of a code, we can work with that. And I think as a regulator, and particularly in this space, we're able to engage with potential signatories to our code one-on-one if they want to do that. And I think it's really important to be a regulator that is open to those one-to-one dialogues, to engage with companies that want to do the best thing and want to demonstrate their good stewardship and improve their stewardship over time. In terms of how we can work with others, I think we need to use forums like this, and OECD, ICGN, etc. They are brilliant forums for us to talk about what we're doing, what Fabio's talking about, what others what investors want, etc. Jen's here talking about the importance of what he's doing and potentially how his company would actually report against the code, how difficult it is, for instance, in terms of risk. So I think as a regulator, you've got to be open to all those complexities and listen and truly think about what we're trying to achieve that's proportionate to a company to report in a proportionate way. And I think we try to make to attend as many international events as possible. For example, the global stewardship networks that the ICGN convene are great ideas to keep us in touch with what's happening. And I think it's the signatures, the code they invest, they report to a code because it's important for them. They want to demonstrate that their approach is good for the market, good for them, and can encourage clients. It's a marketing tool as well. Let's be honest about this. It's not just a regulation, it is a marketing tool. And the more that regulators can work together and can talk to each other, I think the better we'll be at raising standards across the globe, really. And I don't have a silver bullet, unfortunately. I'd love to be able to sit here and say, yes, all the regulators get together, on 10 times a year or whatever. But what we can do is look at the different codes. We can learn from each other. We can talk to each other and use great forums from like this. But I do think it's really important that when you're talking about a code and not regulation, you don't get into the specificity of what you have to do, as in regulation by the back door. It's got to be principles based, and it's got to offer flexibility. And it's got to be accessible to all the different types of investor that there are and different sizes that there are. And the more that we can work together to do that, the better. So it's not a great answer, I'm sorry. I don't have a silver bullet, but it's about engagement, talking, understanding, and understanding the problems, which I think is really important. It's easy for a regulator to set a standard or to suggest something without understanding it. And that means that we have to talk to our potential signatories as well. And we do that a lot in the UK.
You do, and you have lots of public consultations and roundtables, and I think that's very helpful for the users or the signatories indeed. And thank you for mentioning the ICGN Global Stewardship Code Network. So it's a network of majority of national stewardship codes that we gather every 2-3 months so that they can exchange best practices and be informed of changes to their codes.
It's a great forum. Thank you.
Thanks. Jen, so another trend is perhaps that asset owners, clients, they want to have more of a say, a greater influence on stewardship practices. Is this something that you notice in your interaction with clients, and how do you approach that?
So yeah, I think we do notice that, and I think we welcome that. I think this kind of goes back to that earlier point about how asset managers should welcome more clarity from asset owners around what their expectations are on stewardship and on sustainability, and to integrate that into IMAs. So I think that is something that we want to see more of. I'd go even one step further, I think, which is to emphasize that asset owners should select asset managers on the basis of their alignment with their overall goals and purpose and philosophy. And to me, sustainability is not different from any other type of offering that asset managers have around client servicing or fee levels or product choice or product range. Asset owners should express their preference for sustainability in their selection of asset managers that reflect overall what they are looking to achieve.
Thank you. Thank you for that. And I think it's time to open to questions from the audience. And I see already a question from Daniel Bloom from the OECD. What if stewardship codes are not succeeding in a market to convince institutional investors to become more active? Are there other requirements or tools that can achieve this beyond stewardship codes, beyond standards? Does anyone want to take that question? What can I encourage?
I'm happy to. I'm happy to. It's the same answer I just gave. Yeah, asset owners expressing their desires.
Yes.
Like that, and that is a much more direct and effective and clear way to create the incentives in the system. Compared to the stewardship codes, which ultimately are soft guidance expressed in the forms of comply or explain.
Yeah. If the demand comes from your clients, it's very powerful, perhaps even more so than if it's a compliance or a regulatory request, right?
Severine, if I may.
Oh, yes, of course, I didn't see.
Yeah, I can clearly see that depending on the reality of each jurisdiction, as I mentioned in the previous answers, I can clearly see that the regulator should play an important role as well. Of course, we are not saying that they should enforce stewardship practices to asset managers and investors, but the regulator also has some tools that can be used in this case, like coming from comply or explain basis, or depending on the classification of the reality of investors, they should create some divisions. I mean, the largest one should say and disclose this, the smaller one should say and disclose that. And this works like a regulatory nudge into the direction of the use and success of the stewardship codes. That's the way I see. And just to disclose that, I worked for regulators for 20 years of my experience here, and I can see that regulators, when they want and they need then can use other tools at its disposal.
Thank you, Fabio.
I add to that, please. Yeah, I mean, in the UK, it's not comply or explain, and you have to apply to be a signatory to the code. So you have to reach a bar, and if we don't think that you've met that bar in the UK, you won't become a signatory to the code, or probably even worse, you'll be removed as a signatory to the code. And I think that's quite a big nudge, because I think. Thankfully, the stewardship code, as it's got a lot of supporters, and asset managers, asset owners may not engage with some asset managers if they're not actually a signatory to the code. And I think that would encourage people to report in a certain way and to try and meet the standards that we have. So there is a nudge, and I think you're right, Fabio. We can nudge in that, and we can use our weapons. That's the wrong word, but to try and raise the standards.
I have a question for all of you, which I think builds on the question of the role of regulators, but I would extend it to policymakers, because there is this strong expectations that investors conduct stewardship activities and act as responsible stewards. But at the same time, we also see a trend in some markets where shareholders have less rights, so less tools in their toolbox. So their voice becomes less powerful in influencing companies. How is this something that worries you? Does anyone want to comment on that?
I can start maybe. Yeah, so definitely, we are monitoring developments globally, and there's certain jurisdictions that have made, in the last few years, changes to their, let's say, corporate governance frameworks, regulatory or soft law-wise, and in some cases, in our view, weaken shareholder protection. So one example I might mention were the listings reforms in the UK from a few years ago, which there were a few elements on significant on shareholder protections that we were not quite happy about. And I think ICGN was in the same camp there. At the same time, there are also jurisdictions, particularly in Asia, where we see a much more, let's say, positive picture, and we see a strong movement towards corporate governance reform in a positive direction, corporate governance strengthening, which is really linked to try and improve valuations and the overall performance of the market. But that goes through, again, having better performing boards and stronger shareholder rights, and we see that as very, very positive. So I would say it's a little bit more of a mixed picture than maybe what's sometimes in the news.
Mm-hmm, mm-hmm. Thank you, Elisa, and I like a positive light on this. And you're right. Some markets, like Korea, for instance, are doing a lot of reform that has attracted institutional investors and towards the protection of minority shareholders. I don't want to monopolize the conversation, so I see a question for you, Elisa and Jenhui. How can an institutional investors realistically assess whether stewardship activities are improving the performance of their portfolio? That's an interesting and difficult question.
It is. I'm going to give it a go still. It is indeed $1 million question, but it's an important one. So what I mentioned earlier is that we did a lot of systematic work recently to assess the outcomes when it comes to our climate action plan. But that was obviously in relation to specific climate objectives, such as companies setting a net zero target or developing a transition plan and the overall climate risk in our portfolio. When it comes to improving the performance from, let's say, a financial return perspective, we haven't done this work, but I'm happy to report that I've seen a paper, and I was kind of Googling in the meantime, from a few years ago, from Marco Becht at the University of Sauveille, the university, I think, in Brussels, and co-authors Julian Franks from London Business School and Hannes Wagner from Bocconi University. And what they did is the paper is called The Benefits of Access. I can put it in the chat if that's of interest.
Yes,
and
please.
They look at evidence from private meetings with portfolio firms. Now, it is not only sustainability or ESG specific meetings that they look at, but within their sample, which is up to almost 5,000 private meetings between a large active asset manager and its portfolio firms. They also look at governance specialist or the governance dedicated meetings. And what they found is that the trades by the fund managers, so trading investment decisions, capital allocation decisions, increase after the meetings, particularly if the meetings are attended by senior management of the company. And also they find importantly that meeting informed portfolios, as they called, can generate significant outperformance. So again, it's just some evidence, but it's academic evidence. It's quite solid, and it does include stewardship specific meetings.
Very interesting. If you want to share it, I think it's helpful for everyone.
Yeah.
Thanks.
I think for me, the way I would think about that question is to think about the authenticity of the investment process that you as a client is buying. And here I think, our sort of primary view on stewardship as a predominantly active manager is that it should be linked to investment decision making. It's much more effective when you combine it with the capital allocation process, because then you have a joined up view of what stewardship is contributing to the overall investment process itself. So to me, it's not necessarily around measuring the ex post outcomes. And there are some academic challenges, there are some academic papers, but there are a lot of challenges in general with asserting quantifiable links to stewardship outcomes as a result of things that you may or may not have said. Not least, I think, the problem of attribution that Elisa referred to earlier. Companies do things for many, many different reasons, of which shareholders is just one component of how they would make their overall decision. So to me, measuring it ex post is I understand why intellectually it's very appealing, but I also think it's particularly challenging, and it's I will also say quite gameable, in the sense that if you want to create more outcomes, all you have to do is set lower expectations, and your lower expectations from companies will easily be met. To me, I think a better way to assess the contribution of stewardship to the investment performance of a portfolio is to look at the investment manager and interrogate how integrated that stewardship process is with their overall investment process. So how do they think about it in terms of the decisions they make to buy and sell and hold every day? And that, I think, that ex ante view will give you a better view of how that contribution is assessed, albeit assessed on a qualitative basis, not on a quantitative basis.
Thank you, Jeremy. And is this something that you do, if I may ask?
Yeah, so we do it both ways. We have a system that measures the milestones, I guess you could say, that we generate from the engagements that we conduct and where we are on the progress of those. So we can look at it on a quantifiable basis. But I think, and this is what I say when I present that data, I always caution, like, this is not of itself ex post evidence of effectiveness of engagement. The effectiveness of the engagement is the degree to which it is integrated within the investment process that the fund manager is running. It is not about how much Fidelity or any other firm can force companies to adopt practices that may or may not be consistent with their own view of long-term shareholder value.
Thank you. I see also a question on the role of proxy advisor. So I can't guess exactly what the question is, but Sandra Guerra, who is a Lifetime Achievement Awards of ICGN, asked, what change do you expect from proxy advisors?
I think she's probably referring to the stewardship code, which now has a specific section for proxy advisors. So I think, generally we're looking for more transparency from proxy advisors on their approach and to how they deal with their clients and their stakeholders. And I think we've put something in the code, and I don't have the wording in front of me at the minute, that says, they should report on how they engage with stakeholders, and that would include companies. Everybody knows that there are some concerns about proxy advisors and some of the decisions that they may make, and it's quite a a debate both in the UK and in Europe. So we felt that when we updated the code, we should ask for more transparency from proxy advisors in all areas, but particularly in that engagement piece. I think it's important, though, to remember that proxy advisors are only one part of the chain. There are companies, there are proxy advisors, and there are investors as well. And quite often proxy advisors are actually, doing and should be doing what their investors are asking them to do as well. So that, the engagement that proxies should have is really important, where they maybe are suggesting a vote against, but quite often they may be working on a specific mandate from their client, which says they have to suggest voting against in some cases. But we're just looking for more transparency.
Thank you, Maureen.
I mean, maybe I can just add a quick view to this, and I think this continues to be a misconception in the community. The clue to my mind is in the word. Proxy advisors advise, they don't vote. It is for asset managers and owners of the equity capital to vote. The proxy advisors have exactly as much authority as is given to them by asset managers, who may or may not choose to delegate their voting decisions to those advisors. The other thing I'd kind of make a quick comment on, I guess, is, we've seen a lot of chatter in recent times about pass-through voting, voting choice, etc., etc. There's many different expressions of that, so it's that is an umbrella term that captures different ways of implementing it. But one way of implementing it is to simply appoint the proxy advisor and use their off-the-shelf voting policy as being the way you vote. Now that to me is where you are delegating, you're using your vote, but you're choosing to delegate that to your advisor. That to me is not a robust way to conduct stewardship and voting. It might be a convenient way, and it is certainly a cost-effective way, but you are not using the resources of the asset managers that you're appointing to make informed decisions, particularly at the edge cases, and you're not integrating your voting decisions with your engagement activity and/or your investment activity.
Thank you, Danny. And we see indeed a lot of misunderstandings on how proxy advice is used by investors. I see it in meetings with regulators, with companies. So it's important to clarify that. We're reaching the end of this webinar. I see in the chat that if you have any further comments or questions, you can address them directly to the OECD. In the meantime, I want to thank you all for this great panel discussion, and thank you for all the questions. It was really a pleasure to moderate the discussion. Thank you all, and have a great rest of the day.
Thank you, everyone.
Thank you.